Hello. A few months ago, I have made a video about NIO, and this is a car company which is making cars that I really like. I like the way they look. They look fantastic, like they are fantastic cars. But when I first visited the stock, the valuation was absolutely insane. And as I mentioned in that previous video, I would revisit the company and revisit the stock if it severely corrects, and this is exactly what happened. I wouldn't buy back then, but I still want to re-examine the company after it has fallen off a cliff, fallen significantly. And I want to take a look at the company right now and see which kind of price would potentially make sense to me if I wanted to buy the company, or even if it makes sense right now. And so I want to examine the financials a little bit, see what makes sense, and maybe also have a discounted cash flow model for the company and examine whether I should be buying today or not. Now, the first thing that I want to see here is the company's, actually, let me examine the outstanding shares first, which are going up. And this is something that I never like to see, of course. The company tried to capitalize on the uptrend, really. And they sold a lot of stock in order to make those sweet dollars. From, you're looking at 2020 and it's going up in 2020 in terms of stock, as you can see. So they have issued about 60% over here of extra stock, which is absolutely insane. This is a lot of stock, so there's a lot of dilution going on over here. And this is something that you really don't like to see as an investor. And this alone could potentially stop me from entering the company. Although the good thing about it is that this is already priced in, probably. And this can be one of the reasons why the company has been down and down and down. And still, we want to examine whether we should just neglect that, because the company would probably not issue more shares, because the price of the stock is down right now and it wouldn't make too much sense to issue shares. But let's take a look at the financials. Let's see what the company is doing financially here. And the thing that I really like about the company is that they are growing their revenues very fast. You'll see here that there's increasing revenue growth and steeply increasing here, which is something that I love to see. But the net income of the company, let me find it here. The net income of the company, however, is in the negative, and deeply in the negative, and that's something that's obviously not great. You can kind of understand it with a company like NIO. This is also what happened with Tesla, for instance, and these kinds of companies also don't have good margins, like car companies don't have great margins. So you would potentially expect some loss here. Maybe that's something that you can actually negotiate with, just to get some extra growth for the future. That's something that is a possibility. And the balance sheet of the company, I'm pretty sure it's probably looking great because they have sold a lot of stock. And you will see here that the total assets of the company have been increasing massively. And I'm sure it's because of that. But the total equity of the company from 1.2 billion to almost 4.8 here is 2020. In last 12 months, they have lost a little bit, so it's 4.3. So they do have 4.3 billion left in assets. Now, the cash from operations is interesting because it's actually positive. It's turning positive right now. So you may be thinking, why is the net income negative and that negative, and the cash from operations is positive? How can that happen? Well, that can happen because in the cash flow statement is actually all about the cash that is being used and how it's being used in and out, inflows and outflows in the specific period that we're examining. But net income can be skewed by lots of things, and some things could be potentially be depreciation, for instance, or amortization, or expenses that the company has incurred. They haven't actually paid for those, so they're moved to a next quarter or next year. But it's in the net income, they are expenses, and so they are not cash expenses, but they are actually accounted for in the net income statement. And so you will see that deduction in the net income statement, but you won't see it in the cash flow. And so for these kinds of reasons, logistical reasons really, and accounting reasons, you may be easily seeing net income that is actually negative and then a cash flow that is positive. So that can happen in many situations really. But here you will see that the cash from operations is positive and the net income actually was negative, so and almost 1 billion negative. So what caused the increase here? You will see that the depreciation and amortization, as I mentioned, it's actually added back to the cash flow statement because it's not a cash flow expense. And so this is why it's added back. The stock-based compensation is another thing for which I made a separate video about, talking about the hidden dangers of stock-based compensation really. Some other operating activities and the change in accounts payable. Again, this is expenses that the company had, but they haven't been cash expenses. And so these are added back and they are positive in terms of free cash flow or cash from operations, I mean. And so the cash from investing is negative because the company has been investing in some market securities. Now that's a little bit weird. I mean, I wouldn't expect them to spend $3 billion of free cash flow to invest in market securities. So it's almost like they are selling you their stock in order to buy other stock. So it speaks of a board that doesn't really believe in their company's value in terms of the stock, I mean, because I'm sure they believe in the company's value as an intrinsic value, like the company is a good car company, but they probably think that their stock price is overvalued, right? And this is why they're selling it to you, the investor. They're getting the proceeds and then they're actually buying other market securities. So that makes some sense, right? So you can see that they don't really buy back their own shares here. They're just buying other market securities. So the cash from financing here, as you can see, there's no repurchase of common stock, as we mentioned earlier, but there is some issuance of common debt, of short-term and long-term debt here, and the company has been financing themselves quite a lot from common stock. As you see, 5 billion here, 3 billion here, that's a lot, and that's the last 12 months really, so it's going down a little bit, as we said. And the free cash flow is marginally positive in 2020 and was super negative in the previous years, and right now it's almost zero. And so one of the last things that I want to see, actually first off, let's examine the multiples, which are getting a little bit better here. The lower the better, of course. The profitability is going to be in the negative, return on equity expected, and the total debt to equity, even though they have been issuing shares like crazy, they still have 70% of total debt to equity, so not much equity when you compare it to the debt that they have. That's very interesting to notice and not a great thing. Now, the thing that I want to see here is I'm going to use my stock evaluation tool here, which very, very quickly shows me some key metrics in a very, very concise table here that helps me a lot understand, quickly understand what I'm going to be doing with this company. So even if I don't run this tool right now, I already know that I will probably not be investing in the company right now. And that's because I'm looking at the net income margins that are negative. And so look at this, net income margins over here, they're negative for the years that we have data for. And this means that the company cannot make income based on their revenue. So the net income margin is basically net income divided by revenue, and with this ratio we're trying to find how much of our revenue is actual net income. And over here we're talking about negative net income, even though the company is making like 2.5 billion, for instance, over here in terms of revenue. It still has negative growth margin, negative net income margins. And so that's not great to see. We would expect the company to at least become positive in terms of net income in order to have a better view of this, a better understanding of what the company is going to be doing in the near future in terms of their finances. And the revenue growth here is great. That's the good thing about the company, although we don't have data for many years. But you could potentially use something like 20, 25, and 30 here for the next 5 years, which is obviously very, very optimistic for a discounted cash flow model, but I think it does make sense for a company of that sort. The problem here is the net income margin, because when you have a net income margin with this kind of discounted cash flow model, you cannot produce positive results, because this discounted cash flow model takes into account the company's profitability. It takes into account net income of the company, because a company that doesn't make net income is not sustainable. At some point it will have trouble. And so you do want to see positive net income margins, even if some years you can expect the company to have negative margins. And so I'm still gonna go with very, very low estimates here of let's say 4, 5, and 6% of net income margins, at least positive ones, which the company will eventually make, I'm pretty sure. But it's worth understanding that a company has to eventually turn this revenue to actual net income, which is profit, because otherwise the company is not making profit and it's actually selling stock to you, the investor, and this is how they're financing themselves, or debt. There's no other way, really. So free cash flow margins here for the company seem to be at a typical range of, let's just say 95, 100, and 105. And I'm going to use the annual return of 13, which is what I want to be getting from a company. I may actually even want to get more here because it's a riskier proposition. But okay, let's stick to that. And if we calculate here, we'll see that the company's acceptable price is at a high level of $4. As you can understand, that's still way off based on the current price of the company. Now, if you are willing to accept a net income margin which is going to be higher, let's just say 8, 9, and 10, then we are getting a 6.9 in terms of its high projection for the company's price, which is still much, much higher than what the company is making. So I cannot really justify entering the company right now, because even with this great revenue growth here, the net income margins of the company do not really justify my investment in this company. So unless I have a couple of years of positive net income margins that will give me at least some way to know how to value the company's profitability, I will avoid for now. Now, if the company actually reached similar levels like $7 or $8, which do you think is crazy? I mean, this was like 2 years ago or so. I was actually looking at the company when it was $6 or so back in like 2020, and I was thinking of buying it like a lottery ticket. I vividly remember looking at the company at that price, and I was thinking to myself, maybe I should buy it as a sympathy play to Tesla. But I knew that it was a bad investment, a bad long-term investment. I just wanted to buy it again as a lottery ticket, and maybe as a trade, basically, as a swing trade, and just trade it if it goes high. And it sure did, but I didn't buy it back then. Because there is always, as I've mentioned in previous videos, you can buy a company of that sort as long as you understand why you're buying it. Like if you tell me that this company is gonna be the next best thing, and it has insane growth, and I should be buying it for $20 because it's gonna grow tremendously, then I won't be listening to you, because that doesn't make sense. But if you tell me that okay, I'm seeing this company and I'm seeing that Tesla is killing it because of hype, maybe I'll get a little bit as a lottery ticket, and I can trade it. I can actually trade the ticker symbol because there is this hype and this trend right now, and I can capitalize on that. Then more power to you. That makes a lot of sense. I mean, I'm up for that. I understand that, and I wouldn't be worried about such a thing, because I would know that you know what you're doing. But if you're telling me that you are buying value at $20, then I don't know. I mean, you're insane. This is not a $20 stock right now. It may be eventually, but it's definitely not right now. So I hope you enjoyed the video, and if you did, please leave a like and subscribe if you like this kind of value investing content and helps you a little bit with your investments. You may want to leave a like, because that really helps the channel grow and bring the content to more people. And if you did enjoy this video, you may want to look at this one that I made earlier, and it's about Alibaba, for which I bought more as it's crashing again. And so I bought again. I had to. It's a great company. So thank you for watching this, and I'll see you soon, guys. Bye-bye.